Robschild, no investment advice. Welcome to the show where we view financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Wednesday, February 12th, 2025. Today's episode begins with CPI coming out seemingly hot. According to MarketWatch.com, the CPI over here on the left column came out a bit higher than the expected numbers in the middle column, and also higher than the last readings of this, with the core year over year coming in at 3.3% when it was expected at 3.1%, and month over month for the core we rose from a 0.2% to expecting a 0.3%, instead 0.4%. Whoa. On first glance it seems pretty high. I want to break it down a little bit today. BLS, not BS.gov, although some people, I digress. BLS.gov/CPI. Here's the website. Everybody has access to it. CPI for all items rises 0.5% in January. This is including volatile food and energy, so obviously the food and energy drove it a little higher than the core in January, and the notable headline here is that shelter is up. So one of the biggest costs people have is, their rent prices, basically, and if that goes up, that seems to be the driver here more than anything, is what they're suggesting. You can click the PDF right here to see the full news release. I have it here. Well, the first thing I want to do with this is take a look at these charts here. So all items, including food and energy, we've been going up and up and up since September, where year over year was at 2.4%, and now we're at 3%. However, when we take a look at the core for all urban consumers, you can see since July, we haven't exactly made any kind of like higher high, higher low kind of situation. We've been really going up and down between 3.2% and 3.3%. The December reading of this coming out at, or the December report rather, no, the December reading, comes out at 3.2, and then the most previous, again, 3.3. Another number that stuck out to me besides the shelter, you can scroll through this report and see it for yourself. What I like to take a look at especially is like numbers that are, a lot higher than zero for month over month. And these are seasonally adjusted. The most recent report is here in the January column. I don't know if it's too small for you to read, but, the fuel oil was 6.2%. But again, this is more volatile, which is why we like to look at the core more. And one of the parts of the core, though, used cars and trucks went up month over month by 2.2%. And then another one, scrolling down to table 1, U.S. city by average expenditure category. By expenditure category, we have the reading over here on this column here. If we scroll down, the one that caught my eye is transportation services being at seasonally adjusted at 1.8%. Transportation services is one of those leading indicators that really says, how much are people traveling to work and or spend money. I mean, a huge indicator as to if the economy is expanding or contracting is how the transportation sector is doing. So again, this is just like one, month's report, and this, is fairly volatile. It kind of goes up and down, but I found it notable. And, if it continues higher, that could, maybe the economy is going to stay hotter for longer than I expect. Another one right below it, motor vehicle insurance being 2%. So, this is one of those things that, do we have a choice, when it comes to paying motor vehicle insurance? Not really, but sort of. You will have populations of people that feel so squeezed that they're like, well, maybe we need to take a break on the motor vehicle insurance in order to make sure that we can afford everything else that we need. And, when that occurs and, the motor vehicle insurance needs to lower their prices because too many people are dropping coverage, So anyway, people can still afford their motor vehicle insurance for the moment, it seems. It's also worth pointing out that, when things get more expensive, they slow down people's ability to pay for them in the first place. It's not like these things can just keep, something like this can keep accelerating higher forever. It's like the more pressure it has, like I said in my macro show, it's like the higher you go in an air balloon, the further you are away from the ground. Anyway, scrolling through these charts here is pretty fun. It's pretty fascinating. Eggs went up dramatically for that month. I think, here it is, 15% month over month. Not a very sustainable price rise in eggs, apparently, we have going on. And scrolling through, the last one I wanted to bring up, was men's and boys' apparel. And actually, one indicator that I've heard other people reference before is actually men's underwear, nightwear, and swimwear accessories. So this one looks like it went down by 0.4% negative. The reason some people like using this as a semi-leading indicator is that it suggests, how wealthy do people feel, compared to the state of their underwear. It's one of those things that you're not going to buy necessarily. You don't necessarily need new ones very often, but if you're feeling like, I got plenty of money, everything's good, everything in my household is good, and what's the last thing that I'm going to, make sure is good is my underwear. It's a decent leading indicator. Interesting, we had a negative reading on that for the month. And this is across the board for all apparel, men, women, children, total negative 1.4%. But fascinating stuff. Just to scroll through, it's, any reading that is above like 0.3% is notable, and anything, negative is also fairly notable. And especially the ones that are bigger numbers, so you can sort of see what's happening out there with how much people are paying for stuff. And another thing with this report, a thing that I do with reports like this that I don't want to necessarily read through everything, I highlight it. I ask ChatGPT, I say, break this information down into some, a few simple bullet points, and we have them right here. And they just this part of the report just goes through the things that the people writing the report found to be notable. You can pause the video to see it here. We'll take a look at how this report affected markets in a moment. We'll go through our charts. The other main thing of today is that Thursday, tomorrow, we also have the PPI report coming out. So today we found out what consumers are paying. Tomorrow we find out what producers are paying in order to make this stuff that they're selling. Watch macro update 2/11/25. Yes, I finally did an update. Watch this show to hear me read through a lengthy explanation of my daily reminders, things that I think are intensely important. I will change one little update actually today, CPI cooling. I'm going to say it's going flat right now. I am expecting it to roll over to the downside. It's certainly not going up. That's very clear to me, but it's certainly not cooling anymore either. It's been going flat for so long now that I'm gonna change this to flat. But again, the rest of this, no changes for today. Watch the macro update show to hear me go through all of this extremely important information. There's also a separate portfolio update show 2/11/25 that explains my crystal ball readings and my not advice portfolio. This is how I am currently invested. On to the charts. We start with the S&P 500. Interestingly, looking like it was getting pretty bearish during the day, yet recovered to being essentially flat, only down 0.27%. This obviously has to do with the 10-year yield surprising everybody, spiking higher here. I will add that a knee-jerk reaction like this, when you see something that's clearly trending lower and then suddenly a huge pop to the upside, this typically means that whichever moving averages or Bollinger Band strategy you're using, this is what's called an overbought condition. And so at the very least, we should see some sideways movement from here, if not dropping straight down the other way tomorrow would be highly probable. The Fed funds futures now pushed the first cut until September. This one here, even though it's not blue, it's 41% chance of one cut and 14.5% chance of two cuts. So you add that together, at least one cut. So the highest probability of a cut is actually in September now. Before, it was kind of going back and forth between June and July. Again, this is the kind of thing that can change on a daily basis, and every month you look out further has a lower probability of that, actually playing out that way. But, it says where traders' minds are currently, and currently they're looking at higher for longer. That's what we see here, and so that's why we saw a little bit of volatility in the S&P 500, but honestly, surprisingly resilient here with the S&P 500. The 10-year Treasury note yield, upside down, friend, TLT, my favorite place to be, dropped pretty strongly today, 1.36%. I was expecting to stay within this channel, but granted, whenever you have a rising channel, the typical movement is to actually break down to the downside. I'll say, though, that this is not like a solid red candle that opened higher and then just drove down. This is a doji here, and so this is a fight zone. And again, just like the opposite of the 10-year note yield, because of the fact we've been trending up and up and up and up, and then we suddenly have a big break to the downside, this is considered a largely under sold condition. And so the more likely scenario here is to actually snap right back up from something like this. But I'm really curious to see what will happen tomorrow. What kind of will we get follow through? Will we start going sideways here? What's the next pattern developing? Still my favorite place to be, though. I'm still heavily invested in long duration treasury bonds. I found it very, very interesting to see that the CPI came out hotter than expected. Normally, this would make me think, well, that means the dollar is going to be going down, and the dollar didn't budge. We have a doji candle here, exactly sideways. It didn't care at all about the CPI report today. Also, Bitcoin trying to figure out what the heck to do. Between this parallel channel, we're exactly in the middle here, still fighting in this range where we had, all I've explained before, all of these doji candles. There's a huge fight here in Bitcoin. It will be really cool to see where we'll go from here. The fact we're going so straight for so long is telling me that, for Bollinger Bands, for example, these will be getting smaller and smaller and smaller here, which means, whenever you have something like that, the longer you go sideways, the bigger the breakout. And I suspect that the breakout will be perhaps out of this previous parallel channel from this point, especially if we continue to battle here long enough. Bitcoin is very interesting. On one hand, it's a risk asset, and it ties very closely its performance to global liquidity. So the better things are going, the more expensive Bitcoin can get, and the worse things are going, the worse Bitcoin can get, has become a very good leading indicator of markets. And yet people also sort of see it as a inflation hedge. If the dollar is going to be losing value because of inflation, well, why not get some Bitcoin? So I mean, that's why we have a battle here. Big battle here. So yeah, let's see who wins. Should be really interesting. I didn't do a daily show yesterday, but I did notice that oil was starting to look very, very bullish. Just having increasingly large green candles, almost a 3 white soldiers scenario, yet we ended up with a tail on the top of Tuesday's candle. And then today, very interestingly, we engulfed the past 2 days to the downside. Now, if yields follow oil like they normally do, yeah, yields are probably going to snap right back down tomorrow, I highly suspect. And very interesting. The CPI comes out hot, so inflation's high, so things are getting expensive. So oil sells off down. And remember, if oil breaks below $67 a barrel, this trend line has been very solid since 2021. This will be a highly psychological level. 1, 2, 3, knocking on this door a bunch of times recently, many times. If this breaks, this is likely like screaming, yeah, this is the recession now. When oil drops, it's like, yeah, we're not paying for oil anymore. We're not driving our cars as much. We're not buying stuff anymore. We're not using transportation as much anymore. Yeah, watch out. We're not there yet, but I'm starting to wonder if we're headed straight there in the very, very near term. While chaos ensues in U.S. markets, oil markets, other markets, KWeb, where I hold 14% of my own portfolio, we recently broke out of this previous little trend line here, and this thing has gotten just they're very bullish. No other way to say it. We're at a new high that we haven't seen since December 9th. I am hearing whispers of the Chinese economy starting to warm up a little bit. If you don't know, China has already gone through basically a major recession, and it looks like they might be on the other side of that at this point. The other piece of this, though, is that global economics tend to, be together. And if the U.S. markets crash, it's hard to imagine China doing very well. I mean, if there's a real crash, but maybe not. Maybe there'll be a rotation into China again. The valuation of equities in China has been so suppressed. I think some of it is honestly fear of Trump coming in and what he's gonna do to China, or how the relationship between China and the U.S. is. Is it safe to invest in China? I think people are maybe warming up to the idea a little bit more too, which is helping this go higher. Again, my target price is around the $50 range. Still think it's cheap there, actually, but more reasonable. So, and that's a lot. That's like double the price from where it is here. So I'm very happy to be in this position. Inflation is up and wood goes down. What? I thought we got a report saying that the headline there was shelter costs going up. Wouldn't that get wood going? Well, it didn't. I like to use wood as a leading indicator because it's what people are actually paying for wood right now, day to day. And we had a drop today, interestingly, in wood. Admittedly, part of this obviously has to do with yields. When yields go up, mortgages get more expensive, and so then there's fear of people buying less houses. And so, yeah, it's a complex machine, The one piece of it being the solution to yields being too high is yields being too high, because it strangles the economy. It strangles things. It demands a higher yield until, that can't be afforded anymore. And it's like, oh, well, the earnings are slowing down, so actually we're going to have to, ask for a lower yield. It's, markets, they balance themselves out. And this is another thing with bubbles, by the way. I responded to someone's comment recently asking, maybe we're going from an investor's market into a trader's market. It's always a trader's market. There have always been bubbles. There's been bubbles since the 1600s. Mr. Market will often drive the wrong way down the highway 100 miles an hour with an empty cup of suspicious liquids. And some bubbles, like the NFT bubble, or altcoin bubble, I can call it, the .com bubble, the tulip bubble, that's when Mr. Market somehow finds himself driving through space. He's halfway, between Jupiter and Saturn. The point is that markets always eventually balance themselves out. It should have been very obvious to people that tulips were not worth, a tulip bulb was not actually worth the same price as buying a house back in the 1600s, or that everything that said .com wasn't automatically a billion-dollar company. And today, anything that says AI isn't worth $100 billion company. And anything that says crypto after it doesn't really necessarily deserve a billion-dollar market cap. I mean, guys, how many times do we have to learn the same darn lesson? Anyway, I digress. The main point is that markets balance themselves out. All bubbles pop eventually as well. Two more charts. First, Dr. Copper with a PhD in economics has been just doing this crazy move to the upside. Tuesday going straight down, and then today going straight back up the same exact amount. I don't even know what this. Please comment below if you know what the heck kind of pattern this is. Look at this. There, a red candle the same exact size as the next red candle. The first green candle being exactly the same size as the next red candle, being exactly the same size as the next green candle. This is, more than anything, I guess we can call this a bull flag, I suppose. But it also looks like we have lost at least some momentum to the upside, wanting to go sideways here. So it's possible this is a top in copper, but from a straight up chart standpoint, it does still indicate there is a higher chance of more bullishness in copper by this chart alone. PPI data is important. It's how much the producers are paying for stuff like copper, by the way. So let's see what happens tomorrow. Last chart of the day will be gold. CPI was hot as heck. So what would happen to gold? It would go up, right? Well, it didn't. On a closing basis so far for the day, looks like flat. But look at Tuesday's candle. Having such a huge wick up here. This is potentially a reversal here. This doesn't scream that the bulls are in control. We peaked out around 29.43. I've been suggesting we're only an arm's throw length away from the psychological 3,000 level. If the PPI comes out hot tomorrow, maybe that could give gold some legs, but just on a chart pattern basis alone, it's not looking so bullish right now. And I do find it notable that the CPI came out hot and gold went up only 0.22%, with a opening and closing well within the previous days. I'm going to call this a doji candle. Again, this can be a reversal candle that we saw on Tuesday. So that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.